Absolutely, Juanita, and thank you so much once again for inviting us, Citibank, to participate with the San Diego Housing Commission and the Achievement Academy. So, for those of you that were listening to the conversation earlier, Juanita mentioned a little bit about my background. Before joining Citibank, I was part of a nonprofit housing counseling organization, and our purpose was to help support families and individuals achieve homeownership. So, a lot of the workshops that we're currently conducting with the San Diego Housing Commission are workshops that we've been doing for a long time to one to promote the educational component of understanding the parameters of becoming a homeowner, how to prepare yourself for homeownership, things that you can do in terms of step by step. Um, that's one thing. And then, of course, talking about some of the other resources that are available to you through housing counseling, such as the one-on-one interaction with you'll have access to those services through the Achievement Academy, where you would sit down and really the fine tune the focus as to the areas that you would want to work on, depending on your situation, right? So some of you may need support in lowering our debt, or some of you may need support to increase our credit rating. So those types of things are very important uh, in financial vision, right? As you have a home ownership goal, because all those things play together in order for you to be prepared for homeownership and to be a successful homeowner. So today's workshop really is around those components on how to prepare yourself, what things you should really focus in. We'll talk about the buckets that you want to be mindful of, your financial buckets that you want to be mindful of, that will allow you to be mortgage ready, right? Mortgage ready means that you are able to apply for a mortgage and have an option for you. And if we're not quite there yet, that's great. That's fine. We'll talk about some of the things that you can work on, right, to become mortgage ready. So um, once again, we thank you for your time, for being here. And if you have questions, definitely write them in the chat box. We will have a chance to address all your questions. And I will also be taking breaks during the presentation. It's not a long presentation, guys, so don't think that we're going to go on for hours. But I'll definitely be taking breaks over certain sections to reaffirm that if there's any questions that you have, we can definitely tackle those on. So with that, we'll start our presentation. And like I mentioned, I am part of Citibank. I'm a business development officer, and basically what that really entails is working with our nonprofit partners, working with our community relations, so that we are able to support uh, families and individuals with with not just the workshop pieces now that are available through nonprofit partners, but also with specialized programs and of course helping. The main focus, right, is always helping families and individuals achieve home ownership. So I will talk a little bit about just the home buying process in general, right? And I know, if you're in any type of social media platform, chances are you are connected to a real estate agent or someone in the industry that may post about today's real estate market. And they always reference the word hot. It's a hot market. It's a hot real estate market. And essentially, what that means is that it's very competitive, very, very, very competitive. So typically, when a market is competitive, that means that there's a lot of buyers like yourself, meaning there's people that want to purchase a home. And your competition are essentially other home buyers. So just to give you an example, if we have 20 people today in this workshop and we all want to buy a house, and if we're all looking at the same house, then potentially that home will have 20 different offers. So that that's a lot of competition versus maybe having say 40 homes that are available, and only 20 of us looking at homes, and of course that changes up the dynamic where there's a lot more inventory, a lot more homes for sale versus the buyers that are available. So right now, you could categorize our current market as a market where there's a lot more buyers, meaning home buyers, than they are sellers, right? Homes in the market. So essentially, when there's more demand for homes, that brings up the price of homes, and of course, that in turn becomes a very competitive market. So I'll jump right in, and there's always a question that is asked at workshops as to when is the right time to buy, right? How do I know it's the right time to buy? I hear a lot of things, but how can I know when it's the right time to buy? And the answer, I always give my housing counseling answer in the sense that when the right time to buy, you'll know when the right time to buy when you're absolutely ready, not just financially ready, not just financially ready to buy a home, but also emotionally, also professionally, also in terms of family matters, because all those components are part of home ownership. The financial position is just one component of you to for you to be a successful homeowner. What I mean by that is you may be determining, or you may be considering moving to another city, moving to another county, moving to another state. Well, that plays a factor. So essentially, you could be ready financially, but you're not quite ready in terms of your families, or your emotional well-being. So I always like to address this type of question because it's always an intangible and tangible type of solution. Um, Even real estate practitioners are at odds, right, as to where the market is heading, or whether or not it's the right time to buy financially. What we do know is that housing is important. So whether you buy or rent, you have to have a house. There's a need for housing. So if you look at things on a long-term basis where you're buying a home for sustainability, for your family, for yourself, buying a home typically is the right decision long term. If you're considering to buy a home to more of an investment type of opportunity, that's where there's a lot more variables to consider. And in the short term, that's where you would want to really understand the dynamics of what that means. Whether you're trying to make a gain, or whether you're trying to buy a home and sell it for a profit, all those variables carry a slightly more risk versus you buying a home to live in for a long term. So, having said that, is it the right time to buy? Well, is it the right time for you to buy? You answer that question. Others may say, well, it's not quite time for myself because of XYZ factors, right? My family may be increasing, my family may be decreasing. I may have kids that are at that age where they may be moving out. I may have perhaps older family members, such as mom and dad, moving in with me. So all those different factors and variables you have to take into consideration. So if a friend or family member is buying right now, then that's great. That's their decision. Maybe it's the right time for them. Perhaps on our end, or inside our household, we may take a slightly different approach because we may not be quite ready yet, right? So I always like to kind of leave that kind of message for food for thought, because it's not a simple answer, and it's an answer that requires a little more like thinking, a little more sitting at your kitchen table, right, over a conversation with your family, and maybe several conversations, right, as to whether or not it's the right time. But once again, as a long-term commitment to home ownership, buying a home is typically, once again, I have to be mindful of not giving direct advice, but typically long-term investment, home ownership is the right way. So in terms of the home buying process, this is just a real generic type of approach as to some of your steps that you would be taking towards home ownership, right? So Usually the first step involves some sort of research, right? Doing a little bit of homework as to where the market is right now, uh, understanding who does what in the process. Meaning, do you speak to a real estate agent? Do you speak to someone that can help you with the financing piece? So um, one of the many approaches to this is to really understand the financial piece first before you go out to look at homes. The reason for that is you want to really understand what your purchasing capacity is, right? How much is your purchasing muscle? And all that is really reflected on your financials, which we'll go in just a second. We'll go into in just a second. But once you're ready to purchase a home financially, right, where you speak to a bank, a loan officer, a mortgage broker, a mortgage company, and they tell you, yes, Mr. and Mrs. Mendez, yes, Mr. and Mrs. Jones, you are pre-approved for this amount. That's typically when you would want to start working with a real estate agent. The real estate agent is the professional that guides you into finding the property that suits your needs. So once you work with a real estate agent and once you start house hunting, as is sometimes called, you would make an offer based on the market price, the listing price of the home that you're looking at. Um, if your offer is accepted, you would still negotiate some of the pieces of that offer, such as who's going to pay what. Perhaps there might be some repairs in the house that you want to make sure the seller pays for. Um, if let's just say that when you sell the house has a washer and dryer. Typically, you would want to explain that in your offer to make sure that you understand whether that washer and dryer is included as part of the purchase. Um, from there, you would complete your mortgage application. Believe it or not, initially, your pre-approval when you speak to a bank, a mortgage broker, or a loan officer, um, the pre-approval just looks at certain parameters, your financials, meaning your credit, your income, and your assets. But it's not until you actually find a home when your complete application begins to unravel. So um, that's a process that you would work with the mortgage company or the bank, right? So right away, as you're looking at this, you have two key players that are working with you. You have a real estate agent, right? The real estate agent is the one guiding you through the property process, searching for the property, negotiating on your behalf, giving you insight on the current market, on the community, on the schools, right? The mortgage person gives you insight on how much money is it going to cost you every month, right? So that's a good way to visualize your team players. Um, Once again, during this process, there's inspections, there's an appraisal that's done. The appraisal is required to make sure that whatever you're buying that house for, there is enough value or the value matches the purchase price. Um, you complete a final walkthrough, and at the very end, of course, you close on your mortgage. So once again, I was really vague on this overall process, but know that I think the highlight, just that I wanted to come across is that you're going to be working with very two dynamic, important team players, right? You have the real estate agent on one side, and you have the mortgage professional on the other side. They need to communicate whether they know each other or not. Sometimes they've worked in the past together. Oftentimes, mortgage professionals and real estate agents tend to align themselves. But if you meet the loan officer and then you meet the real estate agent on your own, they will essentially come together to make sure that they're working to their best of their abilities to help you and represent you in this process. So I talked a little bit about a pre-approval, right? Initially, you speak to a mortgage professional. They verify three major components. That is your income. They want to see documentation on your income, uh, bank statements. I'm sorry, income documentation such as your pay stubs, your tax returns. They want to see your assets, right? How much assets does this person have, right? Your bank statements typically covers you for that. And they will want to look at your credit. They do run a credit report to determine your credit rating. Based on those three things, the lender can then determine how much of a home you can qualify based on your ability to repay back the debt. So a pre-approval, once again, is like that golden ticket, right? If you recall Willy Wonka and the Chocolate Factory, that golden ticket. Well, a pre-approval is your golden ticket to look at houses, because that golden ticket will tell you how much you can buy, how much can you afford. A $350,000 golden ticket pre-approval letter is a lot different than a $500,000 pre-approval letter, right? They're two separate homes. So you want to make sure that you understand how much power you have in your purchase so that you can concentrate your search based on your capacity. So know what you can buy, goes back to the affordability piece. That's the most important thing in home buying, is to really hone down your affordability. And I'll talk a little bit more about this in the next couple of slides, but essentially the lender does not want to set you up for failure. They want to make sure that you are comfortable with that payment, right? So essentially, you can have two different people, two different families, two different transactions. One of them being comfortable with a mortgage payment of 45% of their monthly income. One of them being comfortable with a mortgage payment only up to 38% of their monthly income. So you don't have to make the calculations, but essentially it's like you can picture like a pizza, right? If that's your income, how much of a slice are you comfortable, right, going towards your complete housing payment? So that varies from person to person, individual to individual, but essentially those are the types of things that you want to really understand, because affordability is so important. Once again, the purpose of purchasing a home is to sustain home ownership, not to put you in harm's way. So affordability is the most important thing when it comes to home ownership. Making sure that you understand the components of what you're paying for on a monthly basis, and once again, understanding that it's a long-term commitment. So closing costs, like everything else, right? Typically, I know Juanita mentioned that the San Diego Housing Commission is working up a new program for auto loans. When you purchase an auto loan, there's some fees that are involved, right? Such as the DMV, the transfer title fee, I believe. There might be another 2 or 3 fees in there. When you buy a home, the fees are part of the transaction. So know that there are fees associated when you buy a home. Some of those fees are what we call fixed fees, right? Whether you're buying a home at 200,000, 300,000, 500,000, some fees are fixed. Some fees have a slightly percentage of the loan amount, such as discount points that typically relates to the loan amount that you're borrowing. So essentially, if you're borrowing $500,000, your discount points will be more than if you're only borrowing $300,000. So, and of course, there are some third-party fees involved. Third-party fees meaning that the fees are not part of the bank or lender fees. They're just fees of the transaction that are involved. So typically, when you sit down with the loan professional, they will go over with you exactly the cost to obtain mortgage financing. And that's where you're going to have a little difference between lender A versus lender B versus lender C. It's always good to compare options with different lenders, not just for the types of programs that each entity can provide to you, but in terms of cost as well, which option would be most cost effective to you. So these are the buckets that I want to spend just a little bit more time on, because these buckets essentially determine whether or not you are mortgage ready. So what do I mean by that? What I mean is, if I essentially do not have all the buckets filled, I may not be mortgage ready yet. So let me repeat that. Mortgage loan financing, there are certain buckets I need to fulfill. If one or more bucket is not fulfilled, then essentially I'm not mortgage ready yet, and I can start working on an action plan to become mortgage ready. So I'll tackle the first bucket, which is credit history. We're going to talk about credit in the next slide, but why credit is important, because it's one of the um, heavier weights of how a lending institution measures your risk. What do I mean by risk? I mean that a credit rating determines the likelihood that you will pay on a monthly basis. The higher the credit rating, the lower the risk. The lower the credit rating, the higher the risk. And if you have a higher risk, then you have a higher interest rate. So essentially, this ties back to the program that Juanita was mentioning, right? Um, for auto loans, and not to sidetrack the conversation, but auto loans work very similar. If you have a higher credit rating, you have a lower risk factor, you are going to have a lower interest rate. If you have a lower credit rating, you're going to have a higher risk score, essentially. So you're going to have a higher credit rating. So I'll come back to the credit bucket in just a second, because we're going to tackle this in the next slide. Employment and income history. Why is this bucket so important? Is because the lender needs to assess my ability to repay back the debt, to repay back the mortgage. How does the lender determine this? Well, they look at my pay stubs, they look at my tax returns. If I'm unable to demonstrate verification of my income, then the lender's going to get a little worried. Why is Sergio not able to provide me with his pay stubs or his tax returns? If the lender can't verify my income, the lender's not going to want to provide a mortgage, because the lender has to verify my capacity to repay back the debt. So, having said that, um, employment and income is important, because once again, that's the that's the source. That's like the pizza dough, right? That the lender will determine how much of a slice is going to go towards that housing payment. If I don't have pizza dough, right? If I don't have income, then how are they going to slice up my pizza to pay my housing payments, right? So if I don't have income, the lender's not going to be able to assess my capacity. So this would be one of those things that I really need to make sure I wrap my house around. Now, there's a lot of questions typically around income. What if I'm on unemployment? What if I'm on disability? What if my income comes from a government source entity? I can definitely answer some of those questions, but essentially, income has to be verified. There's several types of income, right? Employment income, self-employment income, right? Government subsidies income, right? So some of those incomes are what we call qualifying income. Some of those incomes are not. So I can expand a little bit more on the income piece in just a few minutes, but know that income is important, because essentially, if I do not have income, the lender does not or cannot determine my capacity. Um, another question that always arises in the income category is self-employment individuals. What if I'm self-employed, but I just simply don't um, I don't report my income on my tax returns because I get paid cash? If the bank cannot verify income, we go back to the same analogy. Well, if there's no income that the lender can't verify, then it's really difficult for them to assess your capacity. There are programs out there that will verify income based on your bank statements, meaning that if you're self-employed and you receive income, you can verify your bank statements. Hey, these are 10 deposits that I had this month, right? This is verification of income. That carries a little more risk. And if you recall my earlier comment, right? More risk means a higher cost in the interest rate. So income, it's really important. It's one of the important buckets. Debts. How does my debt, how does my monthly debt influence my capacity? So just imagine this. Imagine that I had three credit cards, two auto loans, two student loans, child support, alimony, and a personal loan. Those obligations that I have now, I'm going to carry them into home ownership. Unless I pay them off, I'm going to carry them into home ownership. So if I go back to my pizza analogy, once again, it's the same circle. That's my income. How much of a pizza slice will need to be allocated towards my monthly debt? That's how debts affect my ability to pay a mortgage. So the more monthly debt I have, once again, credit cards, auto loans, student loans, back taxes, child support, any other liability that I have on a monthly basis will affect my capacity. This is a bucket that you have absolute control over. If I have too much debt now, essentially I can work on paying down my debt so I can minimize my ongoing obligations and put myself in a much better position. So once again, going back to my pizza slice or my pizza, right? If half of that pizza right now is being allocated towards my monthly debt, then I'm not going to have a whole lot for my mortgage, and I certainly am not going to have much for my living expenses. So I'm going to have to reduce my debts before I go to the next step, right? So monthly debts is extremely important. If you feel that you need support around budgeting, once again, San Diego Housing Commission can provide resources. And of course, Juanita can provide you with resources as well. But managing your household budget and your obligations are two things you control in this process. So even if you, even before you speak to a mortgage professional or real estate agent, you know that offhand that managing your household expenses and your monthly budget is something you completely control, which the more in control they are, the better your position is into home buying. Assets. Assets are important because the bank's going to want to know, hey, how much savings do you have? Now you don't need 20% of the purchase price in your savings account to purchase a house. However, you do need what we say in our industry, you need a little bit of skin in the game. So even though there are great programs out there that can help finance your complete purchase, meaning they can finance 100% of the purchase price, you essentially are coming in with very little or no down payment at all. You still need to have skin in the game, right? There's still some costs that are associated with buying a home, right? The slide previously to this talked a little bit about closing costs. Well, some of those closing costs are done up front, such as an appraisal, right? So there needs to be some savings in this transaction for you to be mortgage ready. If we do not have any savings at all, then that's where we would have to revisit our household budget to make sure that we are allocating every month towards our savings. And just a quick side note, there are great programs out there that can help you with your down payment and that can help you with your closing costs. Those are typically our specialized programs, down payment assistance and closing costs, that work hand in hand with your mortgage. So essentially, your down payment can be covered, but typically those programs require that you have skin in the game. They require that you bring in 1 to 3% of your own money into the transaction. So even if you are eligible for down payment assistance programs, most of those programs do require that you have a little bit of savings into the transaction. So know that savings is important. You don't need 20% of the purchase price. However, you do need to be mindful that there are some costs involved, let alone moving expenses. How are you going to pay for moving expenses after you buy a house. You want to call mom and dad or sister, brother? I know I would do that, but there, that's an example of cost. There's always cost um, that's associated. There's some, additional costs that are associated with homeownership that you want to be prepared for. Um, Property appraisal is perhaps the only bucket that you definitely don't control yourself. The appraisal is controlled by several factors, one being the demand for current properties in the vicinity of where you're buying your property. So the property appraisal, we typically refer to this as a market type of influence. You yourself, once again, do not have direct influence over the purchase price, but the overall market trends and market fluctuations, along with the square footage of the home, the condition of the home, all that good stuff, make up a value, right? And the bank's going to require an appraisal to be done so that that value is there of what you're purchasing. That is important because that's one of the buckets. This is perhaps, once again, the only bucket you don't control, but it's a bucket nonetheless that determines your mortgage financing. I'll go over credit and then we'll open it up for Q&A. So in case you're bubbling up some questions, keep putting them in the chat box, and then Juanita will go down the line and we'll tackle each question one by one. So credit, right? Credit is it's a real big, robust topic that sometimes it's not always easy to understand. Even in our industry, we always have different perspectives, different answers to perhaps similar questions, but we don't have and we don't know the algorithm of the actual credit score rating. So what that means is it's not an algebraic equation to determine your score. There are several factors. What we do know are the categories that make up that score. I do want to say this, that for those of you that use any type of credit platform that for their educational or resources, such as Credit Karma or the Experian, Vantage, I forget what it's called, but there are several online services and programs that provide you with a free score. They're a great tool, they're a great resource. However, the score is not the same score that you would obtain when you apply for a mortgage. The first reason why is that it's an estimated score. It's an educational score, meaning you're using the information, the resources, and the score for educational purposes. You're not applying for a car loan, a mortgage loan, or a credit card when you're using these platforms. These platforms are to provide you with information. So it's an informational educational score. What that means, it's an estimate. It's an estimate based on categories. It's not until you apply directly with a bank, a loan mortgage company, a mortgage professional, when you can actually get what we refer to as a mortgage, a mid-FICO or a FICO mortgage credit report, where it's the report is for the purpose of applying for a mortgage. Believe it or not, every type of industry, meaning whether it's credit cards, auto loans, store departments, utilities, or a mortgage, has a different variation of how to calculate your score. So if you were to go to Macy's to apply for their store credit card and apply for a mortgage loan the same day, technically you're going to have a variation in your scores. So know that scores are there's a lot of factors in terms of how in a particular industry may calculate your score, and there's a lot of ways of how the industry calculates your score. FICO alone, Ferrari is a company which is a privately owned company that determines credit ratings, has different variations of how to calculate your score. So once again, the topic here is not to dive into the weeds, right, and to try to calculate your score, but know what makes up the score, right? So the first and foremost, I definitely want to stress, is timeliness of payments. The past 24 months of your ongoing payments have 35% of your weighted score. So timeliness of payments. How does that affect you? Well, anything that you have ongoing at this time is important that you stay current on. Why? It's because your current monthly payments, and more specifically, the past 24 months performance influences your timeliness of payments. Let me give you just a quick example. Let's just say that I have an auto loan and I made my January's payment, I send it late. So January 2021, I had a late auto loan payment. That auto loan payment is going to have a deeper impact on my score versus me making an auto loan payment 3 years ago. Does that make sense? Anything in the past 24 months has a heavier burden if it's negative versus after 24 months. So anything within the past 24 months makes up this timeliness of payments. If it's 2 years ago where I made that late payment, chances are it's not even going to impact my score anymore. It'll still be in, you can still see it in the overall history, but it's not going to impact my timeliness of payments. Once again, the past 24 months, past 2 years, are the most important performance measures of my credit score. New inquiries, we refer to this as, obviously when you apply for anytime you run your score, anytime you run your credit report, the inquiry appears on your credit report. At times, multiple inquiries can impact your credit rating. The reason for that is the concern as to why you're applying for credit. So if you are consistently applying for credit, that is deemed as somewhat riskier, right? So those credit inquiries will impact your credit score. If you're applying for a mortgage per se, those inquiries carry a less burden on your credit score. How much does a new inquiry affect your score? There's once again several factors involved. If it's just one or if it's 10, right? One thing I do want to stress is that if you are applying or if your goal is to apply for a mortgage, you definitely want to stay away from running your credit report. You don't need to, borrow money to go on vacation, right? We want to limit that as much as we can. We don't want to buy furniture. We don't want to buy a new car because that impacts, once again, the new inquiries, right? The bank raises their eyebrow. What is this person trying to do, right? Why are they out running their score, and what are they trying to accomplish? Past credit problems. One of the things to look at here is exactly what those credit problems are. Some credit problems are red flags. Others may not be as looked at as heavy, right? So, for instance, if you have an old medical collection past 7 years, chances are the lender's not going to really worry about that too much. You may have been past the statute of limitations. So depending on the creditor and depending on the lender, they may, just tend to overlook it. If it's charged off, meaning that the original creditor simply wrote off the debt, at times they may overlook it. Once again, there's several factors involved, as you may imagine: the time, the length as to the last payment that was made on that account, the amount of the account, and the type of account. Things that are red flags are, for instance, back child support, back student loan payments, deficiency balance from, say, a repossession. Why those things are so important is because those typically tend to grasp the liability factors. So let's just take, for instance, student loans. Student loans, unfortunately, are not dischargeable in a bankruptcy. So if you're past due on student loans, and if you buy a house, guess what? Unfortunately, Sallie Mae or whoever the servicer is, they can put a lien on the house. And we don't want that. Once again, it's a sustainable homeownership. We don't want to set you up for failure. So any type of liability that carries a higher risk, if it's a deficiency balance, if you had a car repossession, and there's a deficiency balance, technically that deficiency balance can decide to take you to small claims. If there's a default judgment that's awarded, well, that can also turn into a lien. So things like that, we just want to make sure that we understand what type of credit problems they are, because depending on the situation, some are deemed higher risk and lower risk. So this is actually a great conversation to have with the housing counselor, with the San Diego Housing Commission Achievement Academy, because you can assess which ones are real high risk and which ones, you can. I hope I'm not coming across to say that you can ignore it, your debt, but which ones carry a lot lesser risk that you can concentrate more on the top priorities. So I think that's a safe way to answer that question. Types of credit is simply talks about the diversity of your accounts. If you only have credit cards, it doesn't mean that you have bad credit, but typically when you have diversity in your accounts, such as an auto loan, a credit card, and once you obtain a mortgage, then that's where you'll see your scores jump right up. Credit amounts and utilization of credit tend to go hand in hand. There's a rule of thumb that if you have credit cards, you only use 30% or less of the available limit. So just to play my example safe, if you have a credit card with a limit of $1,000, 30% of that is $300. So what that means is you typically want to keep that balance at or below 30%. If you go above 30%, then you're going to be using more of your available credit, which tends to lower your credit score. The good news there is that once you pay down your credit card, then there's more available credit, which of course will increase your score. It's a rule of thumb. Some people tend to use their credit cards and then pay them off completely at the end of the month. Also, credit reports pick up on payment patterns. So if you're typically paying off your debt at the end of the month, that's okay, that's fine. Credit reports track how your payments are being made. So the important the important guidance step here is budgeting, right? If you're able to budget and administer your household debt, your household budget, then you'll be able to make sure that you account for your monthly credit card payments, so that one, they're below 30%, and two, that you're always paying them on time. And of course, your account balances, this refers to any other outstanding balance that you may have. This is where you can also, we can also loop in when you co-sign for someone. Just to answer this question now, when you co-sign for somebody, it goes into your account balances as an outstanding debt, even if you're not making the payments on it. But because you co-signed, you're legally responsible for that debt. And if you're legally responsible for the debt, the lender needs to take a closer look at it. Oftentimes, we tend to co-sign for people because they're family members, because it might be our kids or, a distant relative. You just got to be really careful. If you're buying a home, typically the recommendation is not to do it, because it could affect your ability. And if that person happens to fall behind on that debt, it's going to impact you further. So the only type of debt that does not impact you is when you're a co-signer. Co-signer is when you are you and another person are legally liable for the debt. An authorized user is you're simply authorized to use the debt, meaning you can use the credit card. As an authorized user, the account does go in your credit rating, but you can request for that account to be removed from your credit report. As an authorized user, once again, you're simply authorized to use the account. You're not legally liable for the debt. As a co-signer or a co-borrower, you are legally liable for the debt. So usually auto loans, you're going to be a co-signer, you're going to be legally liable for the debt. A credit card, if say your mom has you there as an authorized user to help mom or dad, hey, help me pay my bills, hey, you're going to do some errands for them, As long as they're making the payments on time, it shouldn't impact you. But once again, those are some of the things that you want to take a closer look with a housing counselor to make sure that it does not impact you long term. So with that, Juanita, I think we'll open it up for questions. Make sure that we can go over the Q&A portion.
Perfect. Thank you, Sergio. That was really, really informative. We are opening it up. So anyone that has any questions, feel free to unmute yourself and ask the question. In the meantime, I'm going to ask one so that Sergio starts, and then everyone can start thinking about any questions you may have. Now is the time to ask. And so the first one I see here is, what if I'm still married and want to buy a home by myself?
Question. So if you're married, in the state of California, we're a community state property. So even though I want to buy a house and because XYZ reason, I don't want my spouse to be included in the application, he or she will need to sign a quit claim that they're releasing any interest on the property. But in California, we're community state property, so even if that person signs it, they're still they're still
they still own
50%.
it.
They still own it. Yeah, absolutely.
What?
Yeah. California, it's a community state property. Now, that's once again, it's not legal advice. I got to make sure I say that. But in terms of the mortgage loan, if it's what we call a conventional loan, where there's no insurance from a government entity, then you can actually apply by yourself. But you're still, once again, California is a community property. If you really want to like go into further as to how you can separate all that good stuff, then that's where you would need to speak to an attorney about this. Any type of mortgage program that has an insurance component, such as FHA or VA or USDA, you can apply by yourself, but they're going to want to see your spouse's liabilities as well. So I guess the short is that you can apply without a spouse, but the overall arching is, in the state of California, they're still legal. They still have a legal right on the property. So I'll leave it at that. Once again, it's not legal
That's
advice.
good. Thank you.
Just make sure that where that's heading.
So the next one, they've asked it a couple of times, so I'm going to go ahead and say it again. And this is, how do I know when I'm mortgage ready? Do you review our debt and income?
Yes. So very good question. So whether you speak to a housing counselor or even a mortgage professional, the cool thing about a housing counselor is that you do basically the same steps as you would do with a mortgage professional, but a housing counselor runs your credit report as a soft pull. What that means is it does not have any impact whatsoever on the score, because it's being used for educational purposes. Now, when you run it with a housing counselor, because it's being utilized for financial guidance, the credit report will typically match the same credit report that a lender will be looking at. So there's 3 bureaus: Equifax, TransUnion, and Experian. And typically a lender just takes the score that's in the middle, and that's the score that gets placed into the loan application. So the housing counselor will look at all 3 credit bureaus in one report, right? And they'll begin to assess, with what accounts or where your scores are, and if you have to, have an action plan to improve your credit rating. Essentially, that's one of the biggest advantages of working with a housing counselor.
And guess what, guys? Juanita is a housing counselor.
Take advantage of the service.
So Juanita, so you can check our score without it
Yes.
what did Officer Jill said.
Yeah.
Yes, I do a soft pull, and then we look to see what your credit is, what your debt is. We form a plan to reduce debt if there's too much debt. We also look at savings and what needs to happen there, and then we look to see where your income is now and how much money you can later on put in to increase your overall income, and what your buying power is depending on your current debt,
Uh-huh.
and income. We're able to
Okay.
do all that. Yes.
Okay. I'm not quite ready yet, but okay, that's good to know. Thank you.
You're welcome. Anyone else? The other one you already answered, Sergio. You were, we asked about the co-signing for a car and how it affected home buying. You already answered that one.
Yes, and that's always common. It's always a common theme, right? You know, mom co-signing for son, or son co-signing for cousin, cousin co-signing for best friend. But you know, if it's a car, there's, you know, oh, you're only going to be the co-signer. I'm going to be the responsible party. If you sign one or two or one, you're equally liable for the debts. And unfortunately, if that other person is not making payments on it, it's going to affect you tremendously.
Yeah, short story on that. I had a client, I think we were doing it together, Sergio, this one, where the lady was gonna buy the home and she had co-signed for her son. And her son kept saying he was making the payments. And then when we ran the final credit report, he hadn't made 2 or 3 payments. And she was about to close on the loan. And so she had to actually go, turn in her son's car, pay off whatever he owed in order for her to get her home. I can tell you her son was not happy. He lost his car.
Yeah.
But it was something that had to be done in order for her to close on her loan. Oh, somebody's asking, is Citibank San Diego Housing Commission participating lender? And yes, they are.
We're you know, and let me just, you know, for any type of de-restricted properties where they have de-restricted properties where you can only earn a certain amount of income, right, to be able to purchase a home. We love doing those. We're really good at those. In terms of their down payment assistance programs, we're working to be approved at this time. So that's in the works. But in terms of the specialized properties that have those income restrictions, those you know, we play very well in that space. So thank you.
Yes, because you've been working with a number of our clients with some of the programs, right?
Right.
Because I've been talking to the other gentleman that works with you, that comes on sometimes. I can't remember his name, but one of
Clay,
your,
I think it was Clay.
yes, Clay,
Yes.
Clay. So he's helped some of the clients get through some of the processes. So you just have to look under Citibank. I mean, what you would do, Hayden, no, it's Abdul, Mr.
Mhm.
Warsam, is you would go onto our system and you would look for the approved lenders. You could always go to Citibank, and then Citibank would then look up the approval too. I know what Sergio is saying is that they're working on some other additional approvals, but depending on the program, some of them are already approved for working with them. Is there a workshop tomorrow? Yes, there is a workshop tomorrow. The workshop tomorrow is on the car loans that we were talking about. And we are going to mention a little bit about a new program that we have to refinance car loans. What that does is help reduce your debt to income ratio that Sergio was talking about. So let's say that you have a car loan where you're at 28% interest rate and you're paying $700 or $800. You would come in for an $8,000 loan. We would come in and refinance that and bring it down to whatever a 9% loan would be, depending on the amount you owe.
Oh, I can do that calculation. So $8,000, just to give you an idea, at 20% on a 4-year term, you're paying $278. Remember that number. On a you said 8 or 9%?
9.
On a 9%, now your payment is $199.
You see, guys? That's what we're talking about. Thank you, Sergio, for.
What time is the workshop tomorrow?
Is at 1 o'clock tomorrow. I send out the links every morning. I also send everybody the calendar with all the links on there. So you should all have those large calendars that have all the dates of the workshops. And on the side, you have all these little blue letters. Those are the links. You just click on those links and you can attend any of the workshops. But I also remind you of the workshops every morning and then maybe an hour before. So here it
Is there-
says, yes?
Is there a workshop later today at 3 for the?
No, it's
apprentice?
tomorrow. It's tomorrow at 3, the internship one. Yes, it's tomorrow at 3. Okay,
Okay, attend that for sure.
yeah. So there's another question, Sergio. If SSI recipient, is there any programs for home buying? Section 8 has any program. So they're asking if you're an SSI recipient, there's any programs?
So all the programs for like down payment assistance, closing costs are really based on income. So if you meet the income eligibility, whether your income sources is from SSI, disability, employment, all that is great. You would have to meet the income eligibility criteria. So essentially the answer is yes, every program that's available based on income eligibility, as long as you meet that income eligibility, you can access those programs.
I will say to you that if you are only receiving SSI, and we're talking about money under $1,000, it's more than likely that we're not going to find a program right now in San Diego. Okay, because the houses here are running more in the, I think the minimum is about 375, 400. The housing markets are actually going up now, so we're up more in the 450s, 500s. So that means that you need to be able to make a payment of about $2,800, $2,900 a month with taxes and insurance, except if you're talking about the Habitat for Humanity workshop program that we talked about a few workshops ago, where Shayna indicated that with a $5,000 a month income, your mortgage payment would be somewhere in the 1700s, right, Sergio? I think that's what she said.
Yeah, correct.
Wow.
So it depends on where you are. Now, there's also mobile homes out there. Who knows what those prices are? I mean, you could probably get it, it depends on what you're looking for, and it depends on what your income is like. But only SSI is probably not going to get you what you're looking for in terms of a home. How much money you can make to buy a home? How much money should you be making to buy a home? Again, we just talked about that, and it all depends. And then here's something: can you use your Section 8 voucher to pay your mortgage? There used to be a program. Remember, Sergio? It was
Yeah,
called Home of Your Own program.
Yes, yes.
Back in the day, and that was back in 2016 or 2017, that we put that on hold, I believe.
Wow.
Again, because the mortgages were increasing and our individual home buyers could not qualify for the program and purchase the home at the same time. Because as Sergio was saying, there's income limits. So you cannot be over the 80% AMI, area median income, in order to qualify for one of these low income programs, right? So for a family of 4, that's about $70,000, $80,000, I think.
Yeah.
So in order for you to purchase a home in San Diego back then, you needed to be able to purchase a home in the 400,000 or 500,000 mark, which meant that you had to be making at least $5,000 or $6,000 a month. And so our clients were not able to meet the banking requirements and at the same time the program requirements. So they just put that on hold. So that program is not at this point available. That doesn't mean that you can't use Shayna's program, which is a Habitat for Humanity. I'm not pitching it. I'm just saying that it's a really good program where you can get a brand new home, for $1,500, $1,600, $1,800 a month mortgage payment. And it's a 3-bedroom, 2-bath, I think she said. Am I correct? Correct me if I'm wrong, Sergio, but I think that's what she.
Absolutely. Once again, we're not pitching it, but we had her as an informational speaker a few weeks back, and it's the sweat equity program where you, your family members, your neighbors, would help build the structures, the housing, and they'll meet you to an affordable payment, similar to what Juanita was mentioning. So it's definitely a unique program, and it's an opportunity to consider to reach home ownership.
Right. And then Sergio's program, I know a lot of the banks have low-income targeted programs. The one for Citibank is called Home of Your Own, and that's a 3%.
Home run.
Home run.
Remember,
Sorry.
we're
Home run.
baseball fans. We're baseball
Sorry,
fans.
home run. It's the home run, right, Sergio? And it's a
Yes.
3% down, no mortgage insurance, and you can use 2% of that can be borrowed money or gifted.
Correct. And we do offer a grant towards your closing costs up to $5,000. And the advantage there is because it does not have mortgage insurance. I know we didn't go deep into the actual types of housing payments, but essentially it's a lesser cost for a higher loan amount. So it's a great
Yes.
option, and definitely other banks offer similar programs.
There are so many options out there. For those of you that want the recording for the Habitat for Humanity program, I have that recording. I have it both in English and in Spanish because Shana provided the workshop in Spanish. I will need for you to privately send me your email address because I don't recognize all the individuals on today. So for those that are asking for the recording and I don't have your email, just send it to me. Okay. Well, Sergio, I think we went over a little bit typical that we do that, but I want to thank you for presenting. Always informative, always love your programs. I know Sylvia sent out an email saying excellent, great presentation. We'll see each other again Thursday for the car loan information. And then if anyone has any other questions or wants something from the emails that for me to email you the Habitat information, I'm already seeing some of the emails coming through. You don't have to do them in general public. You can do them as a private email, all right, to me. So with that said, have a great afternoon. Thank you again, Sergio. We'll talk to you soon.
Thank you, Juanita. Thank you, everyone.
Bye.
Thank you. Bye, everyone.
Bye. Thank you.